This week, I'm going to cover the footprint chart. I think it was invented about 15 years ago, so there's not much out there on the footprint, and most of it's pretty useless. So I'm going to give you a rundown of what the footprint is and how I actually use it. And even if you don't end up using the footprint, I'm hoping that this webinar will still be somewhat useful, a little bit like the webinar on volume profile. Okay. And it's something I've only actually incorporated into my trading over the past couple of years. But for me, being able to track the market in this way really helped kind of refine my understanding of the order flow dynamics I've been trying to teach or convey to you over the past couple of months. So I've gone over this briefly already, but I'll first just explain what a footprint chart is and how to read it. Okay. So you might have heard of tape reading or reading the tape. Tape reading being the practice of reading and interpreting the time and sales window, which is what you've got here, and which you can see displays each and every transaction. So the orders going through, buys and sells, the price at which they go through, and the current size at both the bid and ask. And this used to be all you had if you wanted to keep track of order flow. But as you can imagine, it's mentally exhausting having to stare at this shit all day, and basically impossible to keep a kind of mental record or to keep track of historical transactions. So how much has gone through, who's buying, who's selling, where, when. And the footprint chart basically does all of this for you. It records all of this data and it displays it like this. On the right here is your basic bid ask footprint. Each of these candles is a 5-minute candle representative of a 5-minute candlestick like you have on the left here, and on the right you've just got the depth of market. And within each of these candles, I know I've gone over this before, but I'll just quickly explain again. On the right hand side, you've got a record of market buys, and on the left, market sells. So you can see exactly how much was traded on both the bid and ask at each price during a specific time interval. Okay. So on the right, on the DOM here, you can see how much liquidity is currently sitting at each price level, and the footprint just records transacted volume. Okay. So it records the consumption of liquidity. And basically lets you see inside the bar to see kind of exactly how it was formed or is being formed in real time. And there are a few different variations of the footprint chart. You've got volume profile, which you can see here, in which the volume of contracts traded on both the bid and ask at each price is recorded and then presented in a histogram. So a little bit like the composite volume profile I showed you a couple of weeks ago, except over a very short and specific time interval. So this is just volume profile. You've also got a kind of color-coded footprint in which the price points are colored according to the ratio of market buys to market sells. So the more buy volume relative to sell volume at any given level, in this case, the way I have it set up, the darker the blue, and the more sell volume relative to buy volume, the darker the red. Okay, so this is just another way of kind of visualizing imbalance, and some people prefer this way. Then you've got what's called an imbalance footprint, which is basically set up to alert you when there's a specific imbalance in the market. An imbalance being a disproportionate number of market buys to market sells, for example. So I think the threshold here is 400%. So whenever there's an imbalance of 400% or more, the price point will be highlighted in blue or red. Okay, so here, for example, you can see 894,000 traded on the ask, as opposed to 50k on the bid. Okay, so it's kind of measured diagonally, right? More than 400% was traded on the ask than was traded on the bid, and so the ask here is colored blue to represent that. Okay, so this just alerts you to when there's a specific imbalance in the market. Okay, this is just a delta footprint, which instead of showing you how much traded on the bid and the ask, it just shows you the net difference between buy and sell volume at each price. Okay. And I haven't got a screenshot here, but you can also filter the footprint so that it only displays orders over a certain size, which is also quite useful. So these are just some different variations on the basic kind of bid ask footprint, which is what you can see here and which is what I use. And I just find this easy to read, which is of course really important when you're having to make split-second decisions. So here you can see how much traded on the bid and on the ask at each price, and the way I've got it set up, you've also got a visual representation of these numbers in the form of a volume profile. And after having experimented with this yourselves, you may find you want to display the data in a different format, and this will kind of depend on both the information you want highlighted or you're interested in tracking, and also what you personally find kind of easy on the eyes. But this is how I'd recommend you have it set up for starters. One look at this and I can see exactly what's going on. I've got all the relevant information here. So how can you use this information? As always, I'm interested in liquidity. Where is there liquidity and where is there not liquidity? And you might think, well, why not just look at the DOM, the order book, or a heat map if you want to know where the orders are? But I've been over this before, but for me, the books are simply too unreliable. Most of the liquidity is latent, which means it's not just sitting in the book for days. More often than not, it's kind of shepherded or filtered into the market by algorithms, which will post orders split seconds before a level's hit. The reason being that it's inadvantageous for large players to reveal their intentions. You've also got high frequency traders, market makers, and as a result, orders get pulled and stacked in the blink of an eye. So the order book is constantly changing, and without the footprint, it's difficult to keep track of what's going on and where. Okay. For example, I might see 5 million in the book, but when price trades down to that level, that order just disappears. If I see 5 million has traded on the footprint, I know for sure there was and likely still is liquidity there. And the market kind of remembers this, whether it's as a result of order splitting or herding behavior. As I explained in the webinar on scale, the market has a kind of memory. Liquidity pools where liquidity pooled in the past, and illiquidity is persistent, so it persists over time. Okay. So when I'm looking at the footprint, I'm essentially looking for the presence of liquidity. More specifically, I'm looking for absorption. And to illustrate, this is an extreme and an unusual case, but it's still one of the best examples of absorption I've ever seen. So last year, in this range on Bitcoin, almost $250 million worth of Bitcoin traded into these lows on Bitfinex. Massive size. And big size usually moves the market. And if it can't, that tells you something important and potentially very useful. So this is what it looked like on the footprint. And at the time, there was next to nothing in the books down here. And yet you can see huge size trading at this level. And price isn't moving. 700 Bitcoin, 400 Bitcoin. That's an iceberg order, so called because we don't know how big it is. It's hidden, okay? But we know that someone's sitting on the bid here, absorbing all that selling, because we can see it on the footprint. So that's liquidity. Price slips through there and then more absorption. And of course, it's not always this extreme. All I'm looking for is high or unusual volume at a level, and for all that volume to get absorbed. Aggressive buying or selling with no follow through equals absorption. So the market doesn't budge, and that's how you know for sure there's liquidity there. So this is an example of a trade I took on Bitcoin and posted, I think, a while back on Twitter. Price was up at this FTR extreme, up in here, okay, around 11K. And my expectation at the time was that price would break out here. But given the relatively thin move up into the level, I was also quite kind of ready or happy to go short here, depending on what I saw on the footprint at this level. So I'll just show you what happened on the footprint up in here. What you've got here is just a 30-minute footprint, and this is just that consolidation up at the range high. Okay, we're up in here. And what's interesting to me here is the relatively high volume on the ask. Up in this candle here, and in this candle here. It's not actually particularly clear on this 30-minute chart. I just wanted to give you the context. But on a 5-minute or a 1-minute chart, which is what I would have been looking at, that's what I look at when I'm watching the footprint, a low time frame chart. The 12 million here and the 10, 13, 7, 6, 9, that kind of volume was way higher than what was going through on the average 1 or 5-minute candle here. Okay, so it doesn't particularly stand out on the 30-minute chart because it's recording volume transacted over a longer period of time, of course, but on a 5-minute chart, that volume was anomalous. So way higher than what you'd normally get in an average candle in this consolidation. And that's absorption. High volume with no follow through. You can quite clearly see that sellers were willing to provide liquidity here. And as a result, all of that buying got absorbed. So I shorted at market somewhere in here, and a few minutes later we got a 5% drop. Okay, here's another example, and the area we're looking at is down in here, this flag limit, particularly this untested portion, and the area I'm going to show you on the footprint is down in here. Okay, so it's an area I was interested in buying. So when price was down there, I was watching the footprint for absorption. And just note the kind of volume which is kind of normal. This is a 5-minute footprint chart again, and compare that to the kind of volume we get as price comes down into the level. So the level I just pointed out, I've highlighted in grey here, and note the size which trades when price sells off into the level. Down here and down in here, it's not as extreme as the example I showed you on Bitfinex. That was quite a kind of extreme event. This is perhaps a little more subtle, but just note the kind of size which is trading down there is above average. So again, that's what I want to see when price comes into a level. Sellers are pushing, but price isn't budging. All of that market selling is getting absorbed. And you can see absorption on the delta too. So this is just a kind of random section of price action. And what I'm looking at is this candle up here. Okay. You can see in the previous candle, lots of market buying. You get a big green candle. In the next candle, you get a similar amount of market buying, and yet price closes down. Okay. And again, on the footprint, this is that candle. As you can see, lots of market buying, relatively little selling. Okay. And yet the candle closes down. Okay. So that's absorption. And the same concept again here. Another one which I posted on Twitter at the time. And again, what you're looking at is absorption, but just over a longer period of time. In this case, what you've got is a divergence. Price failed to make a lower low, even though over the course of this entire period of trading, there was more market selling than market buying. Okay. So this alerts you to the presence of limit buys. Okay. There are heavy sellers down here in this whole range, but price isn't budging. It's failing to move lower. Here's another quite nice example of absorption at the highs. Again, note the kind of volume which is trading down there. And then watch what happens when price appears to break out here. You get an illiquid move through the highs. There's your stop outs. Nothing particularly significant here, and then over a couple of prices, around 6 million gets absorbed at the high. So again, that's absorption. Aggressive market buying, but people are willing to provide liquidity up at the high there. And as a result, all of that buying gets kind of soaked up. And I can't remember what the context was here, but I didn't take this trade, so can't have been all that interested in the level. But at this point, I should stress the importance of context. For me, the footprint is not something that I would ever use on its own. Okay, I see it as a decision-making tool. So I'll only look at it in areas or at levels I've derived from a candlestick chart. So relevant levels or areas at which I'm already interested in trading. And this is really important because it's easy to get kind of sucked in by the footprint, and what you want to avoid is taking trades on impulse at random levels just because you see size coming through on the footprint or absorption. So remember that it's a tool with which to kind of refine and filter the kind of trades you take, regardless of whether or not you had access to this information. That being said, you can see you get a nice thin move up from the bottom of the range. The move up's thin and therefore vulnerable, and price has clearly hit liquidity. Alex is asking, I understand, but are you using absorption as a trigger for entry? Like, would you be so aggressive to see that 6 million get absorbed and then short immediately if the context was appropriate? What I'd want to see is price start to back off from the level, because of course it's quite possible that price could have consumed that liquidity and then just carried on up. The key is that you get all that market buying and the stops at those highs aren't significant enough to push price through that liquidity. So of course it depends on context, but in this case, when price is breaking highs like that, it's pushing up, I'd want to see absorption and then for price to start backing off. So basically, when you see absorption, relatively large volume near the extreme of a bar with little to no price movement beyond that level, that's something to look out for anywhere you would otherwise look to take a trade. So it's something you can kind of factor into your decision making process, in which you might find gives you the confidence to trade kind of near or at the level, because although you know by now what kind of levels liquidity tends to pull at, we can never be entirely sure. And I think for some of you, and even for me too sometimes, even after all this time, this might be kind of in the back of your mind, what if this level doesn't hold? With the footprint, you can see, yes, for sure there's liquidity there. So in this sense, it's a kind of confirmation. So I'm interested in the presence of liquidity, basically, but more specifically, and this is really where the footprint comes into its own, I'm also interested in how and at what pace buyers and sellers are kind of interacting with that liquidity. And the great thing about the footprint chart is that it allows you to see statistically significant shifts in the order flow, something you just can't see on a candlestick chart. In other words, it allows you to see changes in the relative pace or intensity of market orders. This leads me quite nicely onto breakout trading, which I haven't really covered, but I think that as a form of trading, it's really underrepresented, and I can see why it gets a bad rep, mainly because people get caught on the wrong side of false breakouts. But if you know what to look for and where to look for it, breakout trading can be extremely rewarding, and this is where the footprint comes in really useful. So as usual, I'm looking at major swing points, range highs, lows, the kind of area at which you'd anticipate a strong breakout. So something like this, for example. I'm looking for a relatively clean level. just above or below a low volume area, illiquid move for whatever structure is holding it down to have been largely consumed, and for the point of control to be migrating towards the top of the range. So for volume to start to build just below that level. So some basing or consolidation at the level. And it's during this consolidation that I'll be watching the footprint. And what you'll often get is some absorption at the lows. As I explained in the webinar on volume profiling, what you'll see here is passive buyers, so limit buyers, willing to soak up supply at relatively high prices. But what I'm really looking for here is for buyers to start getting aggressive. So the sudden influx of orders and an increase in volume. So I want initiative here. And rather than trying to explain what I mean here, I'll just show an example so that you can see exactly what I'm looking for. So this is Bitcoin up at 10K, and note how slow the pace of trade is here, okay? No real aggression from either buyers or sellers. Price is just kind of consolidating on low volume. So this is the area we're looking at, this 10K level. You can see what happened after the fact here, but at the moment we're up in here, just below that level. And then all of a sudden you get a marked shift in the aggressiveness of buyers. All of a sudden big buy orders start coming through at the highs. And see that? There's a shift in the order flow which should make you stand up and pay attention. All of a sudden massive volume consuming all of the remaining liquidity just below that 10K level. Okay. Quite apparent on the footprint. And then when price breaks 10K, of course, that's when you get the stop outs. That's when you get that string of zero on the bids. Another really nice example. Again, we have the kind of scenario I just described. You've got flag limit here. Okay, it's been tested multiple times now. Above which you've got this low volume area, this illiquid move. What I'm looking for is basing ahead of the level and for aggressive buying on the footprint. So price is consolidating below that resistance, above which there's basically fuck all on the profile. And then all of a sudden, massive size hits the ask. Okay, it's a marked change in the order flow here. And then again, when price breaks those highs, that's when you get the stops coming out. That's when you get that string of zeros. And just note here, 10 million, almost 5 million traded at 695.50 as price consumes the remaining liquidity up at the top of that flag limit. And this is kind of like the question you asked, Alex. What you want to see on a good breakout is for that liquidity to get quickly consumed and for price to continue on pushing higher. Okay, that's absorption there. But the key here is that price very quickly pushes through it. What you don't want to see is for price to start backing off that level and then moving back down below this high. The issue with a trade like this is that when price breaks those highs, it's gonna move quickly, and so if you try and enter as price is breaking out, you're likely going to get slipped quite badly. And of course, breakouts always have the potential to fail. So you really don't want to be getting in slap bang in the middle of an illiquid move like that as price is breaking the high. So this is where the footprint comes in really useful. If you can position yourself before the breakout, when you see that aggressive buying, you've got a nice kind of buffer in case the breakout fails. So in this case, I got in long when I saw that change in pace on the footprint, basing consolidation below the high, which I expect to be weak, and then all of a sudden aggressive buys start coming in. That's the trigger, the sudden and usually quite dramatic increase in volume. Alex is asking, so you got in long at red or below, roughly? Here. Okay. So below the high, when you get this sudden increase in volume, aggressive buying. So as I explained, if you're breakout trading like this, it's best to position yourself somewhere in this consolidation or as price is breaking out of that consolidation. Because if you try and get in here, as I say, you've got a whole ton of breakout traders also trying to get in at that price, as well as a fuckload of stop loss orders. So price is very quickly going to consume whatever sell liquidities in this low volume area, which is not much. Okay, so one, you're going to get slipped. Two, prices are going to become very volatile. It also has the potential to fail. Okay, so getting in down here, positioning yourself in that consolidation before the breakout, when you see that aggressive market buying, is preferable, because you've got a kind of buffer in case this fails here. And as I say, the context is key. This is kind of the perfect setup. You've defined the structure which is holding down price. You've made an assessment of whether or not you think that's weak. In this case, price has spent quite a long time trading up at that level, so it's likely kind of washed out. And above that, you've got fuck all. Okay. You also want to see this basing ahead of a level, and that's what's going to define your risk generally. And then, of course, when price breaks out, if you're ever unsure of what constitutes an illiquid move, that's it. Clear as down the footprint, a series of imbalances, and usually a string of zeros on the bid. All those stops get triggered, and the market has to start reaching for liquidity. Liquidity, which is going to be especially scarce if price is just broken into a low volume area. And so price will run until it hits that liquidity, and only then will it start slowing down. It's worth noting here that how I interpret what I see on the footprint will vary depending on context. So when you see an imbalance like that, okay, a big degree in variance between the volume traded on the bid and ask, simply more buyers hitting the offer than sellers hitting the bid, it's often going to be on a breakout which will sustain it itself. But if I saw that same imbalance, a string of zeros on the bid after an extended move up, I'd be more likely or ready or prepared to interpret that as exhaustion. Okay, in that case, it's more likely just a flurry of stops and or late buyers, and of course, if there are no new high time frame buyers or influential traders coming in at the highs, then that move's going to fail. It's going to collapse back in on itself. So, depending on context, as I explained in the webinar on false breaks last week, that's something I look to fade. A string of zeros at an extreme. especially if prices come up and hit some significant sell side liquidity. The video I showed earlier was quite a nice example of this, but I'll just draw it out for you. Okay, so if price has been trending down, and then you get the kind of scenario I just described. There's your flag limit, basing ahead of the level, aggressive buying. You'd almost always get that imbalance in here, a string of zeros on the bid, because you've got people stopping out here. The key here is context. When price is trending down, and has been for a long time, this kind of breakout is much more likely to sustain itself, because at this point you've got high time frame buyers and sellers are likely starting to look weak. If I had the same thing after price had been trending up, maybe you get an illiquid move through the highs. You'll also get an imbalance here, a string of zeros on the bid. Those are your stop outs. But this is the kind of move I'd be much more likely to try and fade, especially if I saw absorption here. Okay, down at the lows, if I saw absorption in here somewhere, I'd be much more reluctant to fade that. Okay, if I see it at the highs, that's something I'm looking to sell. Does that make sense? They're both kind of indicative of an illiquid move. The difference is one is more likely to sustain itself. So it's really important that you don't base your trading decisions solely on the footprint. Context is so important. And as always, it's the same principles. Where is there liquidity and where is there not liquidity? The footprint just allows you to see how traders are interacting with that liquidity. So just to summarize, on a breakout, you want to be looking for an increase in volume, a large delta. That's your trigger. And if price breaks out, you should generally expect imbalance, a string of zeros on the bid or on the ask if it's breaking down. But be wary when you see imbalance at an extreme. So at the top of a thin or illiquid move, or after an extended or overextended move up, because in that case, it's more likely that you're looking at exhaustion. And if you get that imbalance followed by absorption, so a large delta over a very few price points, there's a very good chance that price is going to reverse. Okay, so it's a tool which you can use to support your decision making, to confirm or deny whether or not the kind of order flow you're looking for is present, not from which to derive trade ideas. Okay, so it's a tool for timing. It doesn't tell you where to trade, but it can help you decide when to trade. So that's it for today. I hope it's been useful.